Alright, hey YouTube, we are back. So this video is about how to find solid entry. So after this video, you shouldn't have any problem. First of all, identifying your trend. Second, finding a better entry. And I have all three examples of what you're going to see. The market only gives you these three setups over and over and over again. If you don't believe me, go look at the chart and you will see what I'm talking about. So yeah, after this video, you are going to see it. Once you see it, you cannot unsee it. So let's get right into it. So first of all, if you're new here, like, comment, subscribe, and we are talking about trading. So in trading, you have three phases. Either the price is going up, the price is going down, or the price consolidating. If the price is consolidating on the higher time frame, on the hourly 4 hours, we don't touch that. We only place trades when we are going up, when we are going up or when we are going down. Although when the market is consolidating, but the higher time frame, for example, if the hourly is consolidating, but the higher time frame, for example, 4 hour or daily is bullish or bearish, this scenario you're going to see it more and more on the choppy sideways market. This is the one that you're going to see the most, but also has the least amount of working. But if it does work, it give you the highest amount of ROI, risk to reward ratio, on all your trades. So the first setup is pretty easy. Let's say we are trending up, we're going up, we're going up. You mark your levels. The reason why I put that LS is short for liquidity sweep or turtle soup. Some people know them as turtle soup. So you just wait for the price to come down, and as soon as it goes up, and it has to be a very sharp reaction off of it. It cannot go sweep this area and then start like uh, just dilly-dally around the same area. As long as it takes that area out and then sharply start going up with some sort of inverse for value gap or some sort of bullish engulfing candlestick, and if it's bearish the other way around, then you should be fine for going long. This one, however, is the strategy that we use called ICC, indication, correction, and then continuation. And then the intermodal is CCT, candle continuation theory. Let's say this is an hourly candle, this is another hourly candle, this is another hourly candle. But within that hourly candle, the price comes down to the previous hourly wick, goes below it. Once it closes above it, and you just target the most recent liquidity sweep here, or some sort of psychological number, or you can go back to the left side and see if it's something that you find better. However, this is the one that I got a lot of question and people don't know how to deal with this type of setup. And this is, in my opinion, is A++ setup. It's the best possible setup. I don't even remember when was the last time I took one of these trades and it failed, because it almost works every single time. I'll show you. And of course, inverse for value makes all of these setups a higher probability. So for example, in this one, it's pretty straightforward. The price goes up, come down to your POI, you take in, boom, you're out. And this one is pretty straightforward. The market is choppy, but the overall trend is upwards. The price come down, sweep the liquidity, and goes to our take profit. This one, however, lots of people get juked and get scared and they don't get in because they see the price going up, price coming down. In here, they don't get in because they only see a wick. It happens a lot of time. They only see a wick and they think they missed the trade. But then on this one, they also don't get in because they think that the trend is shifting, even though we have a clear target on the left side to target. So the way you can target this is, I call them ILS, internal liquidity sweep. So internal liquidity sweeps are always in the middle, whether if you're going down or if you're going up, they're always somewhere in the middle. Because when we are going down, they always come swap that and continue. When we are going up, same thing. They go and sweep that area. Because if, for example, if you had your setup in here like this, and I mark all these on the chart every time I trade. So I have 1 POI, 2 POI, and I also have this one here. And I usually mark this area, internal liquidity sweep, on either 15-minute or the hourly. So we come down. Once we take out the POI, Let's say there's a clear target that we haven't hit, and it usually works if there's a clear area on the left side. Let's say there's an area that here there's some sort of high in here, way on the left side from previous day or whatever. It doesn't matter, that we failed to take. On the other way, when you're shorting, it's also true. If you fail to take that high, we come down, we close below this POI, and we swap this internal, which is on the 15-minute or the hourly. People think it's the beginning of reversal, but it's not, because we still haven't hit our overall higher time frame liquidity. So once we grab it, once you see inverse for rally gap on this internal, then you get in, then you target that area. So let's get into the examples of it for today's. So let's see. Yeah. So these are the trade that we took out. So this was the first trade. The price is going up, going down. I had my POI set here. The price closed below it, closed above it again. I got in. Quick 1-to-1. And same one goes to here. We had a POI in here. The price came below it, closed above it. I got in, and this was a quick 1-to-2, 2.8. This one, however, since we had this overall draw, I also took this one. So I count this one as a POI. Price came close below it, close above it. I got in for a quick 1-to-1, and of course, as you can see, it didn't work out. However, since the overall price is still going up, and we are in the kind of sort of like a correction. So we have a deep correction towards this POI, towards this internal liquidity sweep. If the price goes below it and we start taking this area, then I'm looking to take a trade from here to here, or I just change the idea of the trade. And as you can see, this was my best risk to reward ratio. We came in, sweep this area, and once we close above it, we got this fair value gap inversed. I got in here, and the take profit was this previous POI area. I could have held all the way up here, but I had to hold it longer, but I didn't want to. I was like, this is plenty of ROI. I'm just gonna be okay with that. So I got into that one, and I got in. So you kind of see all three examples here. And I also took this trade recently that it worked out before the market closed. This was after the market opened. This was on the 4-hour POI. If I zoom out, you can kind of see we broke through this 4-hour level, came above it, closed below it. I got in, just a quick 1-to-1. Didn't want any more than a 1-to-1. Got in and got out. And here, you can also see a liquidity sweep alone, because you can see the market open here. This is the market open. There's also a liquidity sweep. So what did price do? So we swept it before the market closed. Asia opened, and we swept this area again, closed above it. You could have gotten in here and ride it all the way until our internal. I usually like to go from internal to external instead of external to internal, but you can do whatever you like to do. Yeah, so this is the setup. I will turn it into a thumbnail for you guys, so that way you can just take a screenshot it, look at it, have it on your phone or on your desk. So next time when you see it, you can identify it right away. So hopefully this was helpful. Making an hour, over long hour course. I'm probably gonna upload it tomorrow. And that's it. So if you need any help or question, just join the community, send me a DM or post your questions and trades in the community. The link is on the description below. Just join in and ask your question and let me know what you think. As always, thank you for watching. Leave a like and comment. See you in the next one.